Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Sengupta, CEO of Arta Finance, Emily Schlosser, COO of BNY Mellon, Pershing, and Dan Vene, co-founder and managing director of iCapital. They join me to discuss how tech is contributing to wider accessibility of private banking and wealth management services and modernizing financial services. You know, Arta is the winner of the FinTech Trailblazer contest, which was hosted by the Nasdaq data business to uncover innovators in the wealth and invest tech space. It is great to have everyone with us. Welcome to Trade Talks. Congratulations, Caesar, for that mention. And let's start off. Explain to us where Arta sits within the financial ecosystem.
Emily, thank you so much for having me here and for the reward. It's been pretty humbling to get it so early. Arta helps people grow, protect, and enjoy their wealth. It's what we call a digital family office. The ultra wealthy have always had private banks and family offices that give them these financial superpowers. And Arta takes technology with a little bit of AI and makes those available to many more professionals around the world.
Right, and BNY Mellon Pershing, of course, is a legacy name within the financial space. Explain to us where you're within the fintech ecosystem at this point.
Yeah, absolutely. Well, I'll start by saying that Pershing is the second largest business within the Bank of New York Mellon, so it's a great positioning within the industry overall. Pershing itself, at its core, custodies or safekeeps accounts for firms within the wealth management space and enables transactions for those accounts. We also officially entered the fintech space last summer when we launched Wove, which is an advisory toolkit, a digital toolkit for advisors to really help drive their productivity. Fully interconnected suite of applications that allow advisors to help more people.
And Dan, tell us about iCapital.
Sure. iCapital was founded a little over a decade ago, about 11 years ago, with really a singular mission to broaden the access and education of alternative investments. With that mission, we've gone out and built really what we consider the industry operating system for alternative investing. So that's everything from education and thought leadership around why alternatives make sense in client portfolios, straight through the transaction processing in a fully digital, streamlined manner with partners such as these, as well as the full life cycle ownership of alternatives. So when you think about document repository, tax reporting time, investment dashboards, transparency, all of the items that are important to investors when they're making an alternative investment.
Right, and of course financial services is not immune to the AI story, so let's talk about the AI in investing. How is it being put into practice?
So AI is super interesting and super exciting for the potential it has on all of financial services. Especially all the stuff that we are seeing today of large language models. I call that AI for words. Dramatically changes how we can understand people, how people can understand complex financial concepts. We work very closely with Pershing as a broker and a custodian. We work very closely with iCapital to give people access to alternatives. But these are sophisticated things, so people need to understand them better. So there's a lot that AI can do for us. Where we're heavily using AI at Arta is in a bunch of our AI managed portfolios where we use machine learning, which is like AI for numbers. And there we've partnered very closely with Pershing to take many of these very sophisticated, automated public market strategies that have only been accessible so far to the ultra wealthy and bring them to many, many more people in a highly automated, highly personalized, and a much more cost-efficient manner.
And in terms of BNY Mellon Pershing, how are you implementing AI? Because for all intents and purposes, AI is nothing new, right? It's been leveraged for the past 10 to 15 years in virtually every vertical. So how are you implementing it now?
Yeah, absolutely. So, I mean, AI at its core is really a productivity tool, right? And Pershing at its core is here to drive productivity and connectedness in the wealth management space. So we're seeing applications in a handful of ways. One is through our client platforms and portals where AI is at the forefront of the customer experience. It powers the way you can search and navigate our platforms. It powers the way advisors can see what the next best action they can take is. It powers the way advisors can generate reports and analytics and insights for their end clients. We also have applications that fuel our operations. So we can take wire instructions that might come to us from an email and populate that right into our transaction systems automatically. We can actually also use predictive analytics to predict when a trade might fail in the market, so that we can get ahead of that and be more productive moving forward. And then the third thing I would say is we're using it to help bring innovation to market faster. So AI, generative AI, has the capability to draft code and to automate testing so that solutions can really be brought forward to the market much more quickly.
Right, and Dan, let's shift gears and talk about alternative investing for a moment. Why should investors be thinking about that within their portfolios?
Yeah, well, we could spend the entire time on that from my perspective, but I'll give you a couple of reasons why we believe so strongly and why we dedicated our careers to it. When you think about just what's happened in the public markets over the years, and you look at time periods like 2000, where obviously there was sort of a devastating pullback that we didn't reach new highs until 2013, so sort of 13 years of a lost time period for investors. We believe very strongly that investors need to diversify a little bit away from the S&P 500 or the triple Qs, and they have to think about areas to achieve non-correlated returns, more real asset exposure, and really just diversified return streams, higher current yields in a low interest rate environment like we just came out of for a very extended period of time. And so that's really what iCapital represents, and working with partners like BNY and Arta, the ability for investors to augment their portfolios and to sort of reduce that correlation risk that they have today by having so much of their wealth tied up in one or two main indices, which is what most investors are doing because it's worked so well, right? If we go back to kind of the Vanguard premise, it's worked incredibly well, but what we're now starting to see is a lot of herd mentality around valuation, and there's very little differentiation or distinction around companies because it's effectively all index driven, and alternatives are sort of the exact opposite. You can build a bespoke portfolio, you can have much better tax related outcomes through insurance products, you can have defined outcomes in structured investments. You can have real assets exposure, whether that's energy, real estate, private credit. You can have higher current yield streams. So there's a lot of different reasons to bring alternatives into a portfolio. I'll leave you with one more thought, which is simply the size of the market. So we've all talked about kind of how a lot of companies have had trouble going public over the last few years. In fact, we used to have about 8,000 publicly traded companies. We now have just over 4,000. While in the private markets, we've been issuing more capital than the public markets for about a decade now. It's about $1 trillion of private equity issuance versus about $500 billion of public market issuance. So the actual size of the market, there's over 20,000 companies with 100 million or more revenue that are private versus only about 4,000, right? So as an investor, you're missing out on 80% of the investable large growing universe if you're only investing in public markets.
Right. I think part of the challenge is too, it's a matter of accessibility and liquidity when it comes to these types of alternative investments. So how are changing client expectations driving the changes in the way private banking and wealth management services are offered?
So I think that goes to the core of exactly what we're doing at Arta, right? Our mission is to unlock the financial superpowers that have only belonged to the ultra wealthy till now. And so, a lot of ultra wealthy have major investments and significant allocation to alternatives or fairly sophisticated ways of public markets. So what Arta does is provides this comprehensive platform that brings together not just the ability to invest in public markets, but also in alternatives, rounds it off with the right kind of protections through insurance and trust and estate planning in a hybrid platform, which is digital forward. It's tech when you need it, and tech when you want it, and people when you need it, right? So it matches both of those. And through that, with a combination of education, with simplicity and a much more engaging experience, we can bring a lot more people into the fold and give them access to these incredible ways of creating a much better financial future for themselves. And that's why we're so excited to be working with Pershing and in a deep way, and iCapital in a deep way, to bring together all these different asset classes into one.
Yeah, I think it's one of the reasons we're really excited about the Arts partnership too. Just the democratization of many of these offerings aligns very well with our mission, which is to help more people ultimately through financial advice. So you're very much bringing that to the table, and it's one of the reasons that we've also looked to partner so closely. I think we were the first custodian of deep integrations with iCapital, making it possible for clients of Pershing's and iCapital's to filter trades through both of our platforms automatically, upload documents seamlessly, and really kind of make the alternative space much more accessible.
Let me give you one example of how the three of us come together in a very tangible way. So typically in alternative assets or in a private equity, a capital call is a point of stress for most people, right? Because it can come at any point of time. You may not have liquidity. So one of the features we're about to bring out is the ability to point to a public markets portfolio. Maybe it's holding a bunch of US Treasuries, it might be holding S&P 500 or QQQ, and say, when the capital call comes, just automatically pull from there. Now it's a simple thing, but to make that happen requires like deep partnership across the ecosystem. And then once you do that, for many, many users, they can actually just invest in alternatives and switch off. Like the capital calls will happen. When distributions come, they can automatically get invested in the public markets. And that creates a much, much better holistic outcome. And this is something that even the large institutions actually don't have today. I mean, they have human beings trying to do this, but we can actually automate it, make it much simpler for everyone.
Yeah. What's been the impact, Dan, of more people investing in alternatives and taking a portfolio approach? Has it impacted that space, now that you, let's call it high net worth, retail, intermingling with the institutional set, if you will?
Yeah, it has, and I think actually in quite positive ways. So what you've started to see is that companies are now able to stay private longer, and they've been able to have sort of a very long-term perspective. Versus being measured on a quarter-by-quarter basis and having to produce results every 90 days, and if they miss, the stock drops by 20% or something. So it allows companies to really invest in the future and invest in a long-term plan, and it's really patient capital, right? The average investment in a venture space or a growth equity space, is typically 5+ years. It could be even 10 years. A lot of the duration of those funds can be 12 or 15 years, sometimes even longer. Whereas in the public markets, it's a little bit like, what have you done for me, last 90 days, right? And so I think this is a very, very positive thing for the overall markets, because it allows CEOs and management teams to take a longer term perspective. When you hear Jeff Bezos talk about, value creation, he'll even come out and say he doesn't operate, when he was CEO, he doesn't operate the business. He's thinking about where the business is going to be 2 years ahead, right? And so when you're a private company, you actually have the ability to do that and execute on that kind of a time horizon, because the private markets have grown to the point where you can fund your business plan. And as I mentioned earlier, it's actually in some ways easier to fund your business plan in the private markets today than it is in the public markets.
Yeah, particularly as you're looking at alternative forms of capital as well, right? And of course that has to deal with the macro environment, how much credit's being extended, how much liquidity is actually out there. Clearly, we're tightening more than we were, let's call it the past 10 to 12 years. So do you think that's, when you think about the outlook, do you expect that to continue to grow, or is it specific to this environment?
No, I don't think it's specific to this environment at all. In fact, if you just look at the long-term growth trends in private markets, it's been quite persistent. I don't think it has anything to do with sort of volatility that we've experienced, during COVID or 22, 23, with the downdraft and then massive rally in the big cap tech. I think what you're really seeing is that people are starting to understand that in a very low interest rate environment, when fixed income is not working for you, and public fixed income, you have to look at alternative credit. You have to look at private credit and other ways to generate yield. In fact, you can be more senior in the capital structure of a company or an asset in the private markets than you can often find in the public markets. And so not only are you in a better position from a lien perspective or a collateralization perspective, you can generate a higher rate of return as well, typically with less volatility. So it's not for 100% of your portfolio. For most people, it's not even for 50%, right? But where we sit today across the independent wealth universe is generally about 1 or 2% allocation to alternatives. I personally believe, and I think most kind of CIO models would suggest that that's dramatically below where people should be to have a more positive outcome and move along the efficient frontier a little bit.
If I can build a bit on that, I think there's two other interesting aspects that are the changes that are coming about. One is from a fund manager's side, right? Historically, the fund managers used to just be able to go to institutions and be able to raise their funds. All the LPs were institutions, endowments, right? But now we are seeing a pretty big trend with GPs wanting to go to more retail and give access to many more people, because then for them, the capital is actually less volatile. They're more diversified because they have a lot more LPs who, many of whom have put smaller bets and will stay with them through many funds. And for the LPs, it's actually fantastic, because now for a lot of individuals, they have access to this completely new asset class. And in the past, like in typical private bank, you'd have like 5 to 10% of the people who have invested in alternative assets. we have over half our members who have already invested in alternative assets, in private equity, private credit, venture capital. And that's a massive shift because our user base is also a lot younger than a typical 100-year-old private bank. And so you can see like people like the millennials, and I'm just looking forward to the next generation, like how much more leaned in they are going to be because they want to take more control. They want the same things that they've read about, they've heard about, but they haven't had access to till now. And so being able to give that to them actually also creates an incredible opportunity for a much larger group of people.
Yeah, it's interesting because in terms of covering it from a media perspective, I don't recall covering private credit as much as I have in the past 18 months. So the question is, Emily, is there a risk to this becoming too overcrowded or too crowded in this space?
I think we're far from that point. So maybe at some point, but I think given the stats of percentages of portfolios that Dan and Caesar just pointed to, we're far from that space, and we do have a lot of room to grow, and I think growing interest, as you both have suggested.
Right, and of course it all comes down to education as well, and how you're communicating, how alternative investments are different than what you would think of traditional fixed income and equity investments. So I'm sure that's a big part of the platform as well, the education perspective.
That's a very big part. In fact, not only do we provide information on the platform itself, but we do these things called wealth care boot camps. And we do these directly to our members. We often do this with companies. So big tech companies, private funds, we've just gone in and done these wealth care boot camps. And a lot of this is not just about our products. It's actually just talking about an entire category. It's like alternatives. You should really think about it. Or you should think about direct indexes, right? Rather than just buying an ETF. Or these amazing ways of doing tax planning. And so education is a very big component of what we're doing. And we are seeing people actually be much more leaned in. There was this historical view of people who go to financial planners where they want the financial planner to do everything. I think we're increasingly seeing people where they want to do the driving themselves. They may still have the experts around them. They'll ask opinions, but they actually want to be in control. And that's exactly what we want to enable.
Right. Well, I mean, it's kind of like the whole story behind AI. It allows for efficiency and to do deeper dives into different types of strategies, but at the end of the day, it's the advisor, it's a client that's making that editorial decision, if you will.
That's right.
Right?
Yep.
Exactly. All right, and we will wrap it up on that note. Appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.